Well, we have a very uncertain environment. We've seen a big increase in interest rates, much larger than in the past 25 years. And that, of course, was kind of real stress for the financial sector. So these were kind of the adverse scenarios of the past, which have now become reality to some extent. And we must say that actually the financial sector dealt quite well with this increase in interest rates. At the same time, the full effects are not yet visible, so they haven't really worked their way through the balance sheets of the banks, and this is why we caution the banks. As usual, resilience is really of utmost importance at the current juncture. The banks are highly profitable at the moment, and I think it's good if they use this profitability to increase their resilience. Sufficient capital, sufficient liquidity, but also investments into IT to shield against cyber risks.
Yeah, especially if we talk about the economy and also the bank's balance sheets, it doesn't seem that they have increased their risk provisions quite a bit, especially because the economy seems to be so souring. So would you say that needs to come and we will see more provisions and for NPLs going forward?
Yeah, so provisioning has increased a bit, but if you compare it to historical averages, it's still at a relatively low level. And the same actually holds for corporate insolvencies. So also corporate insolvencies, which actually came down over the past 20 years, have increased slightly, but still way below historic averages. And I mean, in all likelihood, given the structural change that we have, given the uncertainty that we have around us, corporate insolvencies are likely to increase, credit risk is likely to increase, and this is why we, on both sides, from the macroprudential side and the microprudential side, really make banks aware of these risks and urge them to increase whatever they can their resilience.
You've already said that the full effect of the monetary tightening hasn't yet arrived at the real economy. Would you say there's a risk of over-tightening? Because clearly, until the ECB will cut again, we could well be in a deeper recession.
Yeah, I mean, the point I made that the increase in interest rates has not fully affected balance sheets, that was a general statement. It's not just about the monetary policy transmission. So monetary policy transmission is actually not that different from the past. And I think when we look at interest rates, we also have to consider other risk factors around us, and this is really the point we're making here, that we always need to look ahead. We need to look at different scenarios, in particular in the uncertain environment in which we are, and that requires action from all actors, the banks, supervision, and also policymakers that have to give a good framework for the operations of banks and the economy.
That brings me to the real estate sector, and it seems to be one of the most vulnerable corners of the economy right now, but also, of course, for the banks, because they are lending to the real estate sector. So how concerned are you about the situation there?
Yeah, as you said, real estate has always been at the focus of our financial stability work and that of many others, and we've certainly seen big changes there. So over years we've talked about the increase in lending to the real estate sector. We've talked about rising prices for real estate, and those trends have reversed. So prices have come down, lending is also much weaker, and that's also part of a natural adjustment. In terms of the risk, I would say that one really needs to distinguish between the corporate real estate sector, the commercial real estate sector, and the residential real estate sector. So we see that commercial real estate risks are certainly heightened, also because the interest rate pass-through is much faster than for the residential real estate. And we certainly see also higher insolvencies in that sector. It looks a bit different for the residential real estate because the indebtedness of the households has not changed that much, and also there's longer interest rate fixation periods, so it takes more time until the higher interest rates have actually reached the household sector.
You're saying that policymakers also need to find a response. We currently are witnessing a budget drama in Berlin. So how much of an impact could that have on financial stability as well if there is no agreement?
Yeah, so I can't really comment on what they're discussing right now in Berlin. So that's up for the policymakers, of course, to take the decisions. the point we make in the report is an even more broader one, and it's also related to climate policies and the energy transition that we're in. And what we're saying is that actually, that's a hypothetical scenario, of course, but moving to CO2 prices which are consistent with the Paris Agreement would actually not do that much harm to balance sheets of the financial sector. I mean, there would be losses, but I think they're manageable for the banks, for the funds, and for the insurers. So what we're saying is that actually the best that policy can do to support the financial sector in the transition to a greener economy is to set clear guidance of what is the direction of travel, what are the measures we are using to deal with the climate crisis. So that's kind of a broader message coming out of the report.
But if you look at all these investment needed, they can't just come from banks, given that their balance sheets are also constrained. So would you say that's an invitation to the so-called shadow banking world to come and also co-finance?
Yeah, I mean, clearly we can't finance the climate transition through banks' balance sheets. So it's long-term investments taking place under a high degree of uncertainty. So we need equity finance also for those investments. So to the extent that non-bank financial intermediaries provide equity finance, of course, that would be exactly the direction of travel. I mean, generally, non-bank financial intermediaries can be very useful intermediaries in the whole financial system. Pension funds, for example, are non-bank financial intermediaries, and many others. So what we're saying in the report is that, of course, we also have to monitor risks in that area, but the approaches that need to be taken, the regulatory approaches, can differ from those for the banks because these are different financial institutions and they play an important role in the financial system.
Perhaps let me ask you one more question on the potential risk from an abrupt change in the interest rate environment, which could, of course, happen. Is that something you're looking at?
Well, I mean, to some extent, the abrupt increase in interest rates has already happened. So we had an increase in interest rates, which was much higher than in the past 25 years. So that's, I mean, in the past, we probably would have said that's an adverse scenario, and that adverse scenario has already happened. And we do see the effects in the financial system clearly. I mean, there's been hidden reserves on banks' balance sheets. They have turned into hidden losses, so some part of the buffers are already gone. But so far, this has been manageable for the financial system. But as I said, it takes time until these changes really fully reflect in balance sheets of the financial sector. This is why we should, I mean, it's fine for now. We're happy with where we are. But of course, looking forward, we need a lot of preventive action to be taken so that the banks remain resilient against the future risks that might be coming.